What if I told you that some of the richest people in the world did not become billionaires by inventing the next smartphone, creating a viral app, or building a revolutionary piece of software? They built something much simpler. They bought land, they developed buildings, they rented properties, they sold properties, and, most importantly, they understood one powerful idea. Real estate can make money in more than one way at the same time. When most people think about real estate, they think about buying a house and waiting for its value to increase. But billionaires think differently. They see land as an asset. They see buildings as businesses. They see rent as recurring income. They see development as a way to multiply capital. And they see time as one of the greatest advantages. Today, we're going to break down exactly how real estate can transform someone from an ordinary investor into a billionaire. And we're going to look at the strategy behind the wealth, not just the glamorous skyscrapers and luxury homes. The first secret: wealth begins with ownership. The biggest difference between wealthy people and ordinary people is often ownership. If you work for someone else, you are usually selling your time. You work 8 hours, you receive a salary, then the process starts again the next day. Real estate works differently. When you own an income-producing property, the property can generate money even when you're sleeping. Imagine buying an apartment building with 10 units. Each tenant pays rent every month. You don't have to personally manufacture a product every morning. The building itself becomes part of the business. Now imagine owning 10 apartment buildings. Then 50. Then hundreds. This is where the mathematics of real estate becomes powerful. One property might make you comfortable. A portfolio of hundreds of properties can make you extremely wealthy. But billionaires don't usually stop at simply collecting rent. They use several strategies at the same time. Strategy number 1: property appreciation. The first way real estate creates wealth is through appreciation. You buy a property for $500,000. Years later, that property might be worth $800,000. You didn't necessarily have to sell anything to benefit from that increase. Your net worth simply increased because the asset became more valuable. Now imagine this happening across a large portfolio. If someone owns properties worth $100 million and those properties increase in value by 10%, that's a $10 million increase in paper wealth. If the portfolio is worth $1 billion, a 10% increase represents $100 million. This is why scale matters. The same percentage increase can produce dramatically different amounts of money when you're dealing with large assets. Strategy number 2: rental income. The second major engine is rent. Rental property can create recurring cash flow. Imagine owning 1,000 apartments. If each apartment generates an average of $1,000 per month in rent, that's potentially $1 million in monthly gross rental revenue. That's $12 million per year before expenses, taxes, maintenance, financing costs, vacancies, and other obligations. Now imagine owning 10,000 units. The numbers become enormous. This is why large real estate companies often focus on apartment complexes, office buildings, shopping centers, warehouses, hotels, and other income-producing properties. They're not simply buying buildings. They're buying cash-flowing assets. Strategy number 3: leverage. This is one of the most important concepts in real estate. And it's also one of the reasons real estate can create enormous fortunes. Leverage means using borrowed money to control a larger asset. Suppose you have $200,000. You could buy a $200,000 property entirely with your own money. But perhaps you could also use that $200,000 as part of the financing for a much larger property. For example, you might use your capital as a down payment and finance the remainder through a lender. Now you control an asset worth significantly more than your original cash. If that property increases in value, your return on your original capital can be much larger than if you had bought a smaller property entirely with cash. But there is an important warning. Leverage magnifies gains and losses. If property values fall or the property cannot generate enough income to cover its obligations, debt can become extremely dangerous. Successful real estate investors don't simply ask, "How much can I borrow?" They ask, "How much debt can this property safely support?" That difference can determine whether leverage becomes a wealth-building tool or a financial disaster. Strategy number 4: development. This is where real estate becomes even more interesting. A billionaire developer doesn't always buy an expensive building. Sometimes they buy something much cheaper. Land. Then they transform that land. A piece of land might be worth $1 million. But after constructing apartments, offices, retail spaces, or a hotel, the completed project might be worth $10 million. The developer has created value. This is called value creation. And it can happen on an enormous scale. Think about what happens when a developer purchases land in an area that is currently undeveloped. They build roads, they construct houses, they create commercial spaces, they add utilities, they build schools, shops, apartments, and offices. Suddenly, the entire neighborhood becomes more valuable. The developer isn't simply waiting for the market. They're helping create the market. Strategy number 5, location. One of the oldest rules in real estate is location, location, location. Why? Because you can renovate a building. You can repaint a house. You can redesign an apartment. But you cannot move the land to another city. Location determines demand. A small apartment in a highly desirable city can sometimes be worth more than a much larger property in an area where very few people want to live. Why? Jobs, transportation, schools, businesses, infrastructure, safety, population growth, tourism, and economic activity. That's why wealthy investors spend enormous amounts of time studying cities and neighborhoods. They aren't just asking, what is this property worth today? They're asking, what could this location become in 10 or 20 years? The billionaire mindset, buy the future. This is one of the biggest differences between an average buyer and a sophisticated investor. An average buyer sees what exists. A serious investor tries to see what is coming. Imagine buying land on the edge of a growing city. Today, there might be almost nothing around it. But then a new highway is announced. A shopping center is planned. Businesses move into the area. Thousands of people arrive. New schools are built. Public transportation improves. Suddenly, that cheap land is located in a rapidly developing neighborhood. The investor didn't just buy land. They bought the future growth of the area. Of course, predicting the future is difficult. Some developments fail. Some cities decline. Some projects never happen. That's why successful investors combine vision with research, financial analysis, and risk management. The power of reinvestment. Now let's talk about something even more powerful. Reinvestment. Imagine an investor buys one property. The property generates profit. Instead of spending all that profit on luxury cars, expensive vacations, and designer clothes, the investor uses the money to buy another property. That property generates more income. Then the investor uses the combined income to acquire another property. The cycle continues. One property becomes 2, 2 become 5, 5 become 20, 20 become 100. This is the power of compounding. The billionaire isn't necessarily becoming wealthy because one property suddenly becomes worth billions. They're building a machine that repeatedly turns capital into more assets. From investor to company. At some point, a successful real estate investor stops operating like an individual. They build a company. They hire property managers. They hire architects. They hire engineers. They hire construction teams. They hire lawyers. They hire accountants. They hire financial experts. They create systems. Now the business can operate across multiple projects and multiple cities. This is a crucial transition. The person is no longer simply buying houses. They are building a real estate organization. And that's when scale can become extraordinary. Real estate is more than houses. When people hear real estate, they often think about residential homes. But the industry is much bigger. There are apartment buildings, office towers, shopping malls, hotels, warehouses, industrial facilities, data centers, student housing, hospitals, land, luxury developments, retail centers, logistics facilities, and mixed-use developments. Different sectors behave differently. For example, the growth of e-commerce has increased demand for logistics and warehouse facilities in many markets. Population growth can increase demand for housing. Business expansion can increase demand for offices and commercial spaces. Tourism can create opportunities for hotels and short-term accommodation. The key is understanding what people and businesses will need. The hidden advantage, inflation. There's another reason some investors like real estate. Inflation. As the cost of goods, labor, and construction increases, replacement costs for buildings can rise. In some markets, rents and property values may also increase over time. Meanwhile, if an investor has long-term fixed-rate debt, the nominal amount they owe may remain the same while the value of money changes. This can potentially benefit property owners. But again, nothing is guaranteed. Interest rates can rise, property values can fall, tenants can leave, maintenance costs can increase, markets can crash. Real estate is powerful, but it is not magic. Why billionaires don't own everything personally. Here's another fascinating part. Large investors often use companies and legal structures to own properties. Instead of personally owning every building, they may have different companies that own different properties or projects. This can help with organization, financing, partnerships, and risk management. Large developments can also involve multiple investors. One investor might provide capital. Another might provide land. A bank might provide financing. A developer manages construction. A property management company operates the building. Everyone participates according to the agreement. This allows enormous projects to be created without one individual paying for everything personally. The $1 million question. So how does someone go from having almost nothing to becoming a billionaire? The honest answer is, usually, they don't do it quickly. The process often looks much more boring. They start small. They learn, they buy an asset, they improve it, they rent it, they refinance or sell when appropriate. They reinvest, they acquire another asset, they build relationships, they raise capital, they develop larger projects, they repeat the process for years, then decades. And eventually, the scale becomes enormous. The secret isn't necessarily one giant deal. It's the ability to repeatedly make good decisions while controlling risk. The biggest real estate mistake. One of the biggest mistakes beginners make is focusing only on price. They say, I found a cheap property. But cheap doesn't always mean valuable. A cheap property in an area with declining population, weak infrastructure, poor demand, and limited economic activity may remain cheap. A more expensive property in a growing area may have much stronger potential. The real question isn't, how cheap is it? The question is, what is the economic engine behind this property? Who will rent it? Who will buy it? Why will they come? What businesses are nearby? Is the population growing? Are jobs being created? Is infrastructure improving? What could change in 5 or 10 years? Those questions matter. How technology is changing real estate. Real estate is also being transformed by technology. Artificial intelligence can help analyze markets. Property management software can automate operations. Digital advertising can help find tenants. Data analytics can identify trends. Virtual tours can help market properties. Smart buildings can reduce operating costs. Construction technology can improve efficiency. And investors can now access information much faster than previous generations. This means the future real estate billionaire may not look like the traditional property tycoon. They may combine real estate with technology. They may use data to identify opportunities faster. They may build highly automated property businesses. Can someone become a billionaire through real estate today? Yes, it is possible. But becoming a billionaire is extremely difficult. It requires enormous scale, capital, strong execution, favorable market conditions, and often decades of work. Most people who enter real estate will never become billionaires. And that's okay. You don't need $1 billion for real estate to dramatically change your financial life. Owning one profitable rental property can be meaningful. Owning 5 can be transformative. Owning 20 can create substantial wealth. The goal should not simply be to copy billionaires. The goal should be to understand the principles that made their wealth possible. Start with knowledge. Before buying property, learn the numbers. Understand cash flow. Understand operating expenses. Understand vacancy. Understand financing. Understand interest rates. Understand taxes. Understand construction costs. Understand property management. Understand your local market. And most importantly, understand risk. A beautiful building can still be a terrible investment. A boring building can be an excellent one. Never confuse appearance with profitability. The long game. Real estate rewards patience. A tree doesn't become enormous overnight. The same is often true with wealth. You buy, you improve, you hold, you reinvest, you repeat. 10 years pass, 20 years pass, 30 years pass, and suddenly, the small decisions you made decades earlier have become a massive portfolio. That's the real secret. Time plus ownership plus reinvestment plus scale. Final thoughts. Real estate has created enormous fortunes because it combines several powerful economic forces. Property can appreciate. Property can generate rent. Debt can provide leverage, development can create value, population growth can increase demand, and reinvestment can compound wealth. But there is no guaranteed formula. Real estate can also destroy wealth when investors overpay, borrow too much, ignore expenses, choose poor locations, or underestimate market risk. The billionaires understand both sides. They don't just know how to make money. They know how to protect money. They don't simply chase the biggest opportunity. They calculate the downside. And they don't build their wealth around one property. They build systems that allow them to acquire, develop, manage, and reinvest in assets repeatedly. That's why real estate can turn a small beginning into something enormous. Not overnight, not through luck alone, but through ownership, discipline, leverage, reinvestment, and time. So the next time you drive through a city and see an apartment building, shopping center, hotel, warehouse, or office tower, don't just see a building. Ask yourself, who owns it? Who earns money from it? How was it financed? Why was it built there? And most importantly, what will this piece of land be worth 20 years from now? Because that's how billionaires look at real estate. They don't just see buildings. They see assets. They don't just see land. They see potential. And they don't just think about today. They think decades ahead. If you enjoyed this video, subscribe to the channel for more videos about wealth, business, investing, and the strategies that can turn ordinary ideas into extraordinary fortunes.